Hey, welcome back to another preview video for this Thursday. We're going to be talking about life insurance and a little bit about health insurance too, but hopefully you already watched the health insurance preview video, because as you know, when you look in Canvas and you look at the lessons that are outlined in Canvas, we really don't have health insurance even listed. So that video was your review, and I also posted the PowerPoint slides as well as a PDF for health insurance. So we will spend a little time on health insurance if we have time on Thursday, but we have a lot to cover when it comes to life insurance. So again, here we have the learning objectives, and as we always like to do, let's hear from Mrs. Siri.
Objectives. After reading this chapter, you should be able to 1. Describe the purpose of life insurance. 2. Explain the factors commonly used in the life insurance underwriting process. 3. Identify the parties to a life insurance policy. 4. Identify the various life cycle stages and their impact on mortality rate. 5. Differentiate between term, whole life, variable, universal, and vol policies and select the most appropriate type of coverage to match a client's specific circumstances. 6. Recommend whether a policy should be replaced based upon quantitative and qualitative factors. 7. Recommend life insurance purchase and benefits distribution options based upon needs, financial resources, and cost. 8. Calculate a client's insurance needs using alternative approaches, including the needs approach, human life value approach, and capitalized earnings approach. 9. Identify the types and uses of life insurance in financial planning. 10. Describe a modified endowment contract. 11. List settlement options for life insurance policies. 12. Understand the taxation of life insurance policies. 13. Describe the common contractual provisions in a life insurance policy. 14. Understand tax-free policy exchanges under Section 1035. 15. Discuss viatical settlements and accelerated benefits provisions and their tax consequences. 16. Recognize the complications for a closely held business upon the death of an owner and the need for buy-sell agreements. 17. Understand the use of life insurance and buy-sell agreements. 18. Distinguish between the three most common types of buy-sell agreements: cross-purchase agreements, entity agreements, and wait-and-see agreements. CFP Board Resource Document. Student-centered learning objectives based upon CFP Board principal topics.
So there you have it. And as always, there at the bottom of those educational objectives, we have the little asterisks with several of those, which means it's part of the requirement for the program. So a lot to cover in this chapter 4. So let's jump right in, and I will basically just walk us through what we're going to cover this Thursday night as a review. So the learning objectives we just heard from Mrs. Siri, and there are a lot of them, 18. So I would spend a few minutes and just review those. This is important, the parties to a life insurance contract. And it's important just to understand that the insured is the person whose life is being insured. The owner of the policy is not always the insured. For example, I own some policies for my kids. I own and control those policies even though my kids are the insured. The beneficiary can be totally different than the owner. And so those are the three parties to a life insurance contract, and you absolutely want to know how they work. This unholy trinity of the insured, the policy owner, and the beneficiary becomes important when we start to look at estate planning issues. And I see that my screen is jacked up here, so let me go make a change real quick. See if I can fix it. That should be a little better. Yes. And it looks like this screen is also a little not perfect. Let me see if I can fix that. I'm sorry. You caught me with some technical issues here. We'll leave that one the way it is. Sorry. So let's go back to the slideshow. This unholy trinity shows the life insurance and mortality risk. This is obviously part of what drives the premiums. The cost of insurance is based on age, and you'll get into that. We'll get into that. You'll get into that every time you do a life insurance quote, obviously, a proposal. Why life insurance? Why purchase life insurance? So this just lists some reasons for having life insurance, and I know you already know what those are, but sometimes it's helpful to have a solid list to review with your clients as you have the conversation about life insurance. measuring the life insurance need. This is a helpful set of, I guess, approaches to calculating how much life insurance does one need. And there's lots of folks who have opinions on which one of these is the best. You probably have some associates or maybe your firm, and you have an approach that you use. And I'm not going to spend a lot of time telling you which one I think works best, but it helps to have an approach, a process to figure out how much life insurance is needed. And when it comes to the test, it's helpful to know what these three approaches are. So here's the steps in calculating the human life value. And you'll see those there. I would spend a few minutes and just be familiar with those five. I think there's just 5 steps. Yep, 5 steps. And it's not that complicated, but the truth is you can get there a lot quicker sometimes just by having an honest conversation about the needs that the client has in relation to what their earning capacity is and so forth. But this is a really helpful process to calculate that, and you should be aware of how it works for the test. The needs approach is the second approach to estimating life insurance requirements. This is the one that I used as a State Farm agent, and it was helpful. But again, the truth is, typically folks will tell you how much life insurance they think they need, and it'll be very close to, it might be very close, it may not, and that's why these tools come in really handy, is when you have a client who thinks they need $100,000 life insurance and you know that it's probably more like $1 million or more. So these are the components that determine how much life insurance is actually needed for the client to provide for their family. Here's another one, the capitalized earnings approach, and this may sound pretty fancy, and it kind of is, but it's just another way to determine the need for life insurance or how much life insurance. This is an example of the capitalized earnings approach, so that's a helpful little snapshot. Here we have 3 different types of life insurance policies: universal life, whole life, and term life. And I am pretty sure that if you're watching this video and you're a student in the CFP program at Rice University, you know the difference. If you don't know the difference, you're going to want to spend some extra time reading the textbook. But basically, term insurance is cheap, inexpensive. It provides life insurance for a certain term. Whole life insurance does just what the name says. It gives you insurance for your whole life. It's obviously, should be obvious, it's more expensive. Whole life insurance is the old, it's been around for a long, long time. It's not that fancy pants. Universal life came along later. It's been around a long time. I bought my first universal life insurance policy for myself back in 1982, and that policy really helped me. It was a great little policy. I'll tell you a story about that in class. But universal life insurance is, the central idea for universal life insurance is flexibility. So it gives you whole life insurance, but it allows you to increase your premiums, reduce your premiums, increase the face value, or decrease the face value. And it comes in option 1 or option 2. One of those is an increasing death benefit. It takes the cash value and adds it to the face value. Option 2, I get confused which one's which, but one of them has, as the cash value grows, the face value grows. So you get that option. The key thing to know about universal life insurance, and this will absolutely be on the test in some way, is the idea of flexibility. Universal life insurance is very flexible, and that's why it's called universal life insurance. So here we go. We just have some more detailed information about each of those types of life insurance, and it does a good job of explaining what it is. So review that in your textbook. Individual life insurance policies are renewable. Here's some provisions. They're not all renewable, they're not all convertible, and they certainly don't all have a waiver of premium. That's an endorsement basically that you would put on the policy for an additional cost waiver of premium. We'll talk about that in class. If it's a term life insurance policy, it absolutely needs to be convertible, in my opinion, and we'll talk about why in class. Renewable, that's for term policies, and that's a good thing to have a renewable policy, and we'll talk about why that is, and we'll also talk more about terms like 5-year term, 10-year term, 1-year term, 20 and 30-year term. Those are much more popular these days. The longer the term, especially for a young, healthy person, the better. So we talked about life insurance a little bit the first time we met, and I think we all agreed that term life insurance is something that is generally the best approach for most clients, young clients for sure, because it's inexpensive and it gives them the kind of protection they need at an affordable price. But to have a convertible policy that's able to be converted to a permanent plan later on is very important, and we'll talk about why. So those are some provisions of life insurance that are important to understand. Here's some limitations to term life insurance, and obviously there's no savings component, and that becomes an issue. That universal life insurance policy I spoke about a minute ago, it did have a savings component, and that was something that was very, very helpful for me at that time in my life. So as you talk to your client about their need for life insurance, and you have the conversation about the different types of life insurance, you need to understand some of the provisions that relate to each different type. Term insurance has some very important provisions, and convertibility is one. Excuse me. That's so good. I hope they do well this season. I just saw a news flash. Looks like Deke Elliott extended his contract, so hooray. But that's not insurance. Back to insurance. Term life insurance, here's some different types of term insurance. So we're going to have 7 slides here. Annual renewable term. This is premium increases annually. So if it's an annually renewable term, let's say you have a 1-year term policy, it's going to renew every year and it's going to go up every year. So a 5-year term policy would go up when it renews at the 5-year mark if it's renewable. And it would be renewable up until some age. My phone is ringing. Let me undo that if I can. Hey, so I should put my phone on, I should always put my phone on airplane mode before class and before I do a video. So term life insurance policy, annual renewable, is an important thing to understand. No term life insurance has a cash value, and the death benefit is always fixed. Annual renewable term, some advantages and disadvantages. Level term, most of the term policies that I sell are level term, but there's, sometimes life insurance for the purpose of providing payment for a mortgage would be a decreasing term policy. As the mortgage shrinks over time, the policy face would shrink over time. The reason you would do that is obviously to have a lower cost. But a level term policy, the term stays the same, or the face value stays the same for the entire term. So that's pretty normal. Decreasing term would be, like I said, a mortgage insurance is essentially a decreasing term policy. So there you have it. Let's see, it looks like I've lost my ability to change screens. Oh, there we go. 6 of 7, level term and decreasing term, some advantages and disadvantages you'll want to know. Appropriate uses only for temporary life insurance, such as education expenses during grieving process. So level term and decreasing term, let's see. I lost my mental place there. Universal life insurance. So we have 3 slides here. And there you have it. Flexibility is the key component in universal life insurance. Flexibility in terms of the premiums, the face value, and the cash value, what you can do with the cash value. And the insured does not direct the investment. So universal life insurance comes in a couple of different forms. It could be a variable universal life insurance policy. That's not what we're talking about right now. We're talking about anything that just says universal life insurance is not going to have an investment component that is that allows the insured to carry the risk. The universal life insurance policy is always going to be one, when you see that on a test, it's always going to be the universal life insurance that the insurance company carries the risk. It's a fixed account, so just be aware of that. Universal life insurance policies, we've got Universal Life A, that's the adjustable death benefit. So the beneficiary receives the cash value or death benefit. Universal B is same as A, except that the death benefit will vary directly with the cash values. So Universal B is more expensive. That's what I had in my universal life policy. I like the idea of getting paid the face value plus the cash value. But I didn't realize at the time it actually cost more, because obviously you're paying a higher premium to receive a higher death benefit. And that's the way whole life insurance works. It has a cash value. Universal life is not whole life, but it's based on the same building blocks. In a whole life policy, it builds cash value, but that cash value is part of the death benefit. So you don't get the death benefit and your cash value. And a lot of people do not understand that. So as a certified financial planner, you need to understand that in a way that you can communicate it so there are no surprises for your client. Life insurance agents, 1.2 million professionals in our country are selling insurance. And the truth is, a lot of them are not. They're selling products that their company is telling them how to sell based on how they get paid. And so when you get into universal life insurance, whole life insurance, there's a lot of ignorance out there on both sides of the table. So our job is to help folks understand what they have, what they need, and what their options are. So when it comes to universal life insurance, while it's a great fancy pants product, it is complicated. It's complicated to explain. Here we have variable universal life. And this one, when you see the word variable, you need to just know that it has, the risk is now on the client to make some choices related to investments. And so that's the difference. 3 types of universal life insurance. Some advantages and disadvantages. Whole life insurance, 6 screens here on whole life insurance. So we'll talk about this in class, but I've already kind of outlined a little bit about what it is. And a whole life insurance policy is the typical, when you say permanent life insurance, it's the original whole life insurance, which means insurance for your whole life. Typically the premiums are set for the whole duration of the policy typically, and the death benefit is as well. It's not like universal life, it doesn't go up and down. So check out these slides. I'm going to post this in Canvas so you can see them, and this will frame out our conversation on Thursday night related to life insurance. Whole life insurance, some more, screen 2, screen 3, about cash values, and the guaranteed rate, minimum guaranteed rate of interest, and also this whole idea of being participating. When you see the word participating, anything related to a life insurance policy, participating means there is a dividend. So dividends are a big part of some life insurance policies if they're participating, and that's important to know. Whole life insurance, there are various types, and we'll talk about some of those. When I bought life insurance for my kids, a limited pay life insurance, an example of that would be a 10-pay life insurance policy. So I paid for 10 years, and then it was paid for. I have one of those for each of my kids. Great great policies, in my opinion. They worked very well. Whole life insurance advantages and disadvantages. Spend a few minutes on the screen and just make sure you understand it. And if you have questions, we'll talk about them Thursday evening. Appropriate uses for whole life insurance. I always just say that if you have a lot of resources, then we should be talking about permanent life insurance for a lot of reasons. In this course, we're not going to go deep into the strategies and the applications for advanced life planning cases. But there are many, and they work very well with the tax code, in the context of the tax code. The IRS makes the rules, and as CFPs, we get to help our clients take advantage of those rules. And life insurance is one of the ways we get to do that. And it's a fantastic tool for a lot of reasons for people who have excess cash, excess money. There's just many things you can do with life insurance in the estate planning arena. So here we have some now customized whole life policies. And again, the application here would be for estate, survivor, and some other business applications. Dividend options. Dividends, you get to choose what to do with your dividends. And so paid up additions is one that I always liked. We'll talk about these different dividend options in class. But they're somewhat self-explanatory, and they're good to know. So I don't know that that'll be on the test, but I wouldn't be surprised. Surrender charges will definitely be on the exam. Surrender charges are a big, important piece of the puzzle in planning life insurance, and as well annuities. So we'll talk about that. Surrender charges. Non-forfeiture options are another important piece of the life insurance landscape that we need to understand. Variable life insurance, non-forfeiture options. So we will talk about VULs, variable universal life insurance policies, and how they work. We'll spend a good deal, we'll spend a few minutes on VULs. That will help us prepare for annuities as well, variable annuities. So here's a feature comparison of common life insurance policies. And this is a good screen for us to spend a little time on and just reflect. I would encourage you to, this is in your textbook. It's also one of the slides that I'll upload into Canvas. But just spend a few minutes here in meditation, quiet, peaceful meditation. It's a lot of information on that slide, but I would encourage you to look at it and be familiar with it. It'll help frame out our conversation. Taxation of life insurance. This is another very likely to be on the test. This whole MEC deal is somewhat complicated, at least it is to me. If you're a tax person, it's probably not so complicated, but it is difficult to explain. A modified endowment contract, a MEC, is something we all need to know. And basically, the bottom line is if you overfund one of these products, you can set yourself up to have a MEC, a modified endowment contract, and you will lose certain tax benefits. And so we'll spend some time talking about the tests and the rules, boundaries, and limitations in life insurance that can get you into the MEC, the world of the MEC problem. Taxation on whole life insurance is an important thing to understand when we get into estate planning especially. Taxation of life insurance surrender benefits received during life. If your insured surrenders their policy prior to death, they may take the cash value as a lump sum, interest only, or installment payments. And those are all going to be outlined in the policy provisions for the life insurance policy. And we probably won't spend a lot of time on those in class. We will spend some time on taxation of life insurance and annuities. And we'll spend a little time talking about exchanges too, 1035 exchanges. 1035 exchange is an important thing to understand if you're working with clients who have existing life insurance and they need to do something different. 1035 exchange is very helpful, very handy, especially with annuities. Taxation of benefits received during life. These are some ways that the policy is taxed even if it's transferred. So these are important things to understand. We'll study them again in estate planning. You will study them again in estate planning. I won't be there for estate planning. But we'll get introduced to some of these taxation issues as we look at insurance Thursday night. Viatical settlements. It's a growing in popularity. We'll talk about viatical settlements, accelerated death benefits, and there's that bonus question from last time, TCJA. What is TCJA? It's got T must be tax. Group whole life insurance. So group life insurance is another topic we will cover and you'll need to be familiar with and how it's taxed. So it's pretty straightforward, but I would encourage you to spend a few minutes just getting to know the taxation of group plans. Taxation of group term benefits as well. So there are some group whole life plans and group term plans, and there's some rules about how they're taxed. Here are some provisions, life insurance provisions that you'll want to be familiar with: the grace period, incontestability clause, misstatement of age or gender. Some more provisions, assignment provisions, and the suicide clause is an important provision to understand. Reinstatement, policy loan provisions, very important. And again, the MEC, the issue of whether or not the policy is a MEC, a modified endowment contract, becomes an important part of the conversation. Beneficiary designations. There's probably nothing that, life insurance, setting it up and reviewing it and making sure it's up to date. The beneficiary designations are very important. And so we'll talk a little bit about beneficiary designations. And I would expect to see a question on the exam about beneficiaries and settlement options for life insurance. Here's some ways that insurance companies will offer to settle a life insurance claim or a death claim. And lump sum is what most people choose. Some people like to take interest. I'm always surprised when I have a client who wants to keep the money with the insurance company and let them pay interest only. And they'll pay 7% or so. I think the last time I did that was about 7%. With pretty low interest rates in the market, that wasn't bad. And then annuity payments is their favorite way. It's a structured settlement these are just some ways that life insurance companies want to settle the death claim when their client files. Buy-sell agreements. This is one of the most common applications for business purposes to use life insurance or disability insurance. Buy-sell agreements, though, are a document that is created typically by an attorney for the purpose of protecting business owners, and life insurance is a great tool for that purpose. So we'll spend a little time talking about buy-sell agreements and how life insurance can be a wonderful tool to fund the buy-sell agreements. And these are different types of buy-sell agreements and some advantages and disadvantages. Another type of buy-sell agreement, a cross-purchase, and some advantages and disadvantages. And here's a summary. And I would spend some time just understanding the distinctions the differences of these buy-sell agreements so that you can at least have a pretty good understanding of which one is which. At least know that there are more than one type of buy-sell agreement and know which ones they are. And we'll spend a little time. I'll try to answer any questions you have between now and Thursday, though I would encourage you to spend some time in Chapter 4, Life Insurance. And moving forward, I will post this, post a video. Hopefully I'll do a video between each class, and I'll just go through the PowerPoint and make a few observations. I will make some edits to the PowerPoint and then upload the revised edition of the PowerPoint into Canvas, and I'll also export the PowerPoint to a PDF, and that's what I will use when we get to class, because I will probably just pull the document up and then I'll be able to put that on the screen, and I can do all kinds of fun stuff with my little Apple Pencil and my iPad and have some fun. So that's what I'll do. I'll use the PowerPoint I'll use the PDF instead of the PowerPoint. So hope that is helpful. There's a lot of material in this course, and all I can say is we're going to do our best to get through it. And in the process, I'm going to try to help you identify three things. One, I want to help you identify the most likely questions you're going to see on the CFP exam. And to do that, we're going to spend some time really going through the questions that are in the portal, your portal questions. So you need to be spending some time answering those questions, and that's a great way to get ready for class. We'll do some questions in class. The second thing I want to do is, or need to do, is cover the essential elements that are outlined by the CFP board. So those are those little asterisks things. So that's number 2. But number 3, which I think is very important, I want to do my best to help equip you as a certified financial planner to be a good advisor, a good consultant in the arena of risk management. And so as we talk about life insurance, we all kind of agreed that life insurance is one of the most important areas of focus for a financial plan. It's a big risk. We're all going to die. And so, in fact, the opening quote in my book, Make Your Money Count, is Ricky Bobby. He says, 98% of us are going to die at some point in our life, so a little planning goes a long way. First quote in the book. Yep. I think I can find it. Yeah, right there it is. Ricky Bobby, check it out. Is that cool? I like Ricky Bobby. He's funny. So thanks for watching my video. I'll try to not make them so long next time. I'm going to go ahead and post this in Canvas, and I'll see you Thursday at 6, and drink lots of coffee. Have a good day. Have a good week.